Good morning. Welcome you to another episode of Golden Eye Learning, where you learn more, learn extra. This is Deepak Kumar, accounts trainer. So guys, let's just quickly go ahead with the today's video agenda. So in this video, we will cover one of the important question of redemption of preference share from mock test paper of the year 2020. It comes frequently in exams. So now let's first understand what is preference share. I am not going to give you definition and all. I am just gonna take you through the main features of preference share. So you will understand what is preference share. So first thing of the preference share is that they will have fixed dividend. Preference shareholder will get fixed rate of dividend like 4% preference share, 5% preference share, 6% preference share. In a company, the dividend of preference shareholder will be paid first, then the equity share and capital also. If the company is wound up, then capital of preference shareholder will be paid first, then the equity shareholder. They do not have voting right. Second thing is that these preference shares have preferential right. So this is the main thing about the preference share. So now let's come to the redemption, the main core of redemption of preference share. So what do you mean by redemption? Redemption is nothing but a process of repayment. Redemption means what? Just repayment, that's it. When company issue preference share, they got money. Now it's time for redemption. For example, shares were issued at 100 and are redeemable at 110. Section 55 of Companies Act 2013, we know that this section talks about redemption of preference share. So now let's go through this section and understand what is preference share. Only fully paid shares can be redeemed. No partly paid shares can be redeemed. If in the question partly paid shares are given, then we have to call the unpaid amount. So preference shares can be redeemed by fresh issue of shares or out of profit or combination of both. Now you are making redemption of preference share. So you need money for redemption. So you need cash for redemption. So how are you gonna get that money? So there are only two ways to get that money. First is fresh issue of share. Second is you can use your profits, the profit which the company has earned in the past and which are in free reserves. Free reserve means the profit which are available for distribution as a dividend, not specific reserve, not capital reserve. So now come to the question. The capital structure of X Limited consists of 20,000 equity shares of 10 rupees fully paid up and 1,008% redeemable preference shares of 100 each fully paid up. The undistributed reserves and surplus stood as general reserve 80,000, profit and loss account rupees 20,000, investment allowance reserve is 10,000, out of which 5,000 is not ascertained as free reserves. Cash at bank amounted to rupees 98,000. Preference shares are to be redeemed at a premium of 10% and for the purpose of redemption. What is premium? When extra payment that is done at the redemption. When shares are issued at face value, then at that time itself they will mention that we are gonna pay you back at premium 10 rupees extra, 20 rupees extra. Section 55 talks about how the company is gonna bring the money for this premium payment. In the last year, there has been an amendment in this provision to which company section 133 applies. Section 133 applies to every company which has objective of earning profits and have to follow accounting standards. The company to which section 133 applies follow accounting standard can only use profits, cannot use security premiums. Section 133 does not apply, does not follow accounting standard, can use profit or can use security premiums. Before the amendments, all the companies were able to use security premium as well as profit. But after the amendments, the company to which section 133 applies can only use profit, cannot use security premium. The directors are empowered to make fresh issue of equity share at par after utilizing the undistributed reserves and surplus, subject to the condition that a sum of rupees 20,000 will be retained in the general reserve and which should not be utilized. Pass journal entries to give effect to the above arrangements and also show how the relevant items will appear in the balance sheet of the company after the redemptions carried out. So now come to the answer. In the books of X Limited, journal entries, date, particular, debit, credit. First entry is bank account debit to equity share capital, being the issue of 2500 equity shares of rupees 10 each at par, 25,000. So how we get 25,000? So let's come to the working note. So working note, now number of shares to be issued for redemption of preference share. So we have 1000 preference shares of rupees 100 each. So face value of shares redeemed is equal to 1000 preference share into 100 is equal to rupees 1 lakh. Less profit available for distribution as dividend. General reserve 80,000 minus 20,000. Why we are deducting 20,000? Because it is mentioned in the question that we have to retain 20,000 rupees in the general reserve. So general reserve is equal to rupees 60,000. Next is profit and loss 20,000 minus 10,000 premium. How we get 10,000 premium? 1 lakh rupees into 10% premium is equal to rupees 10,000. Set aside for adjusting premium payable on redemption of preference share. So 20,000 minus 10,000 is equal to rupees 10,000. Next is investment allowance reserve 10,000 minus 5,000. Why we are deducting 5,000? Because it is mentioned in the question that 5,000 rupees is not ascertained as a free reserve. That's why we are deducting 5,000. So total of this 60,000 plus 10,000 plus 5,000 is equal to 75,000. So 1 lakh rupees minus 75,000 is equal to rupees 25,000. So number of shares to be issued is equal to 25,000 divide face value rupees 10 per share is equal to 2500 shares. So 2500 equity share into face value rupees 10 per share. So in this way we get 25,000. So next entry is 8% redeemable preference shares capital account debit rupees 1 lakh. Premium on redemption of preference share account debit 10,000. Why we are debiting premium on redemption of preference share? Because for payment of premium on redemption of preference share is an expense of the company. So that's why we are debiting 10,000 to preference shareholder rupees 1 lakh 10,000, being preference share capital due for redemption. So next entry is third, preference shareholder account debit to bank account rupees 1 lakh 10,000, 1 lakh 10,000, being the amount paid to preference shareholder. Next entry is to premium on redemption 10,000, 10,000. In this entry we are utilizing profit and loss to write off the premium payable on redemption of preference share, being premium on redemption written off. In the next entry we have to prepare capital redemption reserve. Why do we prepare capital redemption reserve? We will understand through the example. So this is a case of before redemption. Balance sheet, liabilities amount, assets amount. Equity share capital rupees 4 lakh, preference share capital rupees 2 lakh, profit and loss rupees 8 lakh, liabilities 10 lakh, assets 24 lakh. So total of the balance sheet is 24 lakh. So total assets is 24 lakh minus 8 lakh. 8 lakh is the profit and loss. So up to rupees 8 lakh we can distribute as a dividend. So divide total liabilities rupees 10 lakh is equal to rupees 1.6 times. So in this case the liabilities of the companies are 1.6 times secured. So next is, this is a case after redemption. Balance sheet, liabilities amount, assets amount. Equity share capital 4 lakh, preference share capital nil. In that column, why preference share capital is nil? Because preference share capital has been redeemed. Next is profit and loss 8 lakh, liabilities 10 lakh. And on the asset side, assets rupees 22 lakh. Due to redemption of preference share, assets has been reduced with the redemption amount. Earlier the assets was 24 lakh, now assets is 22 lakh. So total of the assets rupees 22 lakh. So after redemption, the security of liability will be 1.4 times. Total assets 22 lakh minus profit and loss rupees 8 lakh divide total liabilities rupees 10 lakh is equal to 1.6 times secure. When the company does redemption of preference share capital, then security of creditor will reduce. To prevent of this happening, section 55 came into existence. Such capital redemption reserve is created from free reserves, and free reserves are generally profit and loss, dividend equalization reserve, or any reserve which can be utilized for distribution of dividend. Now come to the balance sheet. Particular notes number rupees, equity and liabilities, shareholder funds, share capital, notes number 1. To understand, now come to notes number 1. Share capital 22,500 equity share. We have 20,000 equity share plus 2,500 equity share we get from the fresh issue of share of face value rupees 10 per share is equal to rupees 2,25,000. So share capital is equal to 2,25,000. Next is reserves and surplus. Now come to notes number 2, reserves and surplus. General reserve rupees 20,000. So in the question it is mentioned that we have to retain 20,000 rupees in these general reserves. Capital redemption reserve 75,000. Investment allowance reserve 5,000, because 5,000 is not ascertained as a free reserve. So that's why in investment allowance reserve rupees 5,000. So total of this 1 lakh. So reserves and surplus is equal to rupees 1 lakh. Now come to asset side. Current assets, cash and cash equivalent. So 98,000 it is mentioned in the question, plus 25,000 cash we get from the fresh issue of share, minus 1,10,000 for redemption of preference share. In this balance sheet we have not totaled, because we are only asked in the question that to show the relevant item in the balance sheet. So if you have any doubt, then please let me know in the comment section. Thank you.